Hey everyone! Welcome back to the channel. If you've been thinking about investing in mutual funds or just want to understand how they work, you're in the right place. In today's video, we're going to break down the entire process of how mutual funds work, from your initial investment to how your money grows, and why understanding fees like the expense ratio is super important. Let's dive in. So, how does it all start? Well, the first step in investing in a mutual fund is making your initial investment. When you invest in a mutual fund, you are pooling your money with other investors, creating a large pool of capital. Let's say you invest 10,000 Indian rupees. This money is then converted into units of the mutual fund. Each unit represents a share of the fund's overall portfolio. The value of each unit is based on the net asset value, NAV, of the fund. For example, if the NAV is 100 Indian rupees, your 10,000 Indian rupees would get you 100 units. Now, you own a portion of the fund, which will grow or shrink depending on the performance of the assets the fund holds. Now that your money is pooled with others, it's time for the fund manager to take over. The fund manager is a financial expert who is responsible for managing the money you and others have invested in the fund. The fund manager uses the pool of money to buy and sell securities. These can be stocks, bonds, government securities, or other assets. The goal is to generate returns for you, the investor, by making smart investment choices. One of the key roles of the fund manager is to diversify the fund's investments, meaning they spread the money across different asset classes, sectors, or even countries. This helps reduce risk by not putting all the money into a single investment. The idea here is to reduce the impact of any one investment's poor performance. By holding a range of different investments, the risk is spread out. Now let's talk about how mutual funds generate returns for you. There are a few ways mutual funds can make money. Capital gains. If the fund sells a stock or bond at a higher price than it paid, that's a profit, and you get a share of it. Dividends. Some investments in the fund may pay dividends, which are a share of the company's earnings. Interest. If the fund invests in bonds, it receives interest, which is passed on to you. These returns can either be paid out to you as income or reinvested back into the fund, allowing your investment to grow over time. This process is known as compounding, and it can really help your money grow in the long run. Now, here's something you need to pay attention to when investing in mutual funds: the expense ratio. The expense ratio is the fee charged by the fund for managing your investment. This fee includes everything from management fees paid to the fund manager to other administrative costs like customer service and legal fees. Let's say the expense ratio is 1%. That means for every Indian rupee 1,000,000 you invest, 1,000 Indian rupees will be deducted every year for managing the fund, no matter how the fund performs. This fee is automatically taken out of the fund, so you won't have to pay it directly, but it still impacts your returns. While low expense ratio funds are generally more appealing, sometimes paying a slightly higher fee can be worth it if the fund has a proven track record of outperforming its competitors. It's important to strike the right balance between cost and potential returns. To summarize, you start by making an initial investment, and your money is pooled with other investors. The fund manager takes over, buying and selling assets to grow the value of the fund. The fund generates returns from capital gains, dividends, and interest. And finally, you need to understand the expense ratio, which is the fee the fund charges for managing your money. Understanding how mutual funds work, from the initial investment to the impact of fees, is key to making smart investment choices. If you're looking to invest, be sure to research the fund strategy, performance, and expense ratio to see if it aligns with your financial goals. Thanks for watching. If you found this video helpful, give it a thumbs up, drop a comment if you have any questions, and don't forget to subscribe for more investment tips and financial advice. See you in the next video.